Welcome to Iron Financial, where we forge stronger portfolios by stress testing the market. We don't just look at the headlines, we take a sledgehammer to the balance sheet to see what holds up and what completely crumbles under pressure. Today, we are putting ARS Pharmaceuticals, that's ticker SPRY, directly under the microscope. Now, this is a company that on the surface looks like an absolute winner. I mean, it beat revenue estimates for the quarter, it's got a first-of-its-kind product hitting the market, and it's disrupting an industry that really hasn't seen any meaningful change in decades. But beneath that shiny exterior, the financial statements are telling a totally different story, a story of a massive, almost unbelievable cash burn. Our job today is to figure out if its framework is solid steel or if it's actually set to collapse under its own weight.
Okay, so here's how we're going to break this down. We're going to conduct a full structural analysis, starting with the blueprint of the company and its flagship product. Then we'll really stress test the financials to find all the weak points. From there, we'll walk the battlefield of market access. And finally, we'll deliver our verdict on whether this is a stock you build a position in or one you just run from.
All right, let's start forging the bull case. Every strong investment, I mean every single one, needs a powerful story, a real reason for capital to believe. For ARS, that story is forged around a single, potentially market-shattering product. So first, let's examine the blueprint. So ARS Pharma is a biopharmaceutical company. They're headquartered down in San Diego, founded back in 2015. Their entire mission, their whole reason for being, is built around developing treatments for severe allergic reactions. We're talking anaphylaxis. They are an incredibly focused company, like a sniper rifle aimed at a massive, established market that's been dominated by one type of product for what feels like forever, the auto-injector. And ARS, well, they aim to completely disrupt that decades-old market with something entirely new.
Okay, hold on a second. So let me get this straight. It's an EpiPen without the needle. Epinephrine has been around forever. It's the gold standard, no question. So is this genuine innovation? Or are we just looking at a new fancy package for a very old drug? I mean, how big of a deal is a nasal spray, really? People are totally used to the auto-injector. They've been trained on it for years in schools, in offices. Is it fear of needles truly enough to build a billion-dollar company? You're going to have to convince me that this isn't just a clever gimmick.
And that's exactly the right question to be asking. And you know what? The market is already giving us an early answer. In its very first full year on the market, Neffy booked $72.2 million in U.S. net product revenue. Look, that is not a small number for a launch year. That shows us that there is real, tangible demand out there. We're talking more than 22,500 healthcare providers have already prescribed it. That number tells us that doctors and, more importantly, patients see a genuine benefit here. This isn't just some gimmick. This is a strong initial build that proves the concept has real traction. Now, let's look at these numbers, because what's really interesting about this slide is the story it tells about the company's evolution. Look at the full year numbers. Total revenue of $84.3 million is solid, no doubt. But the components are what really matter. Only about $10 million of that comes from collaboration revenue. That's the money they get from partners for hitting development or sales targets in places like Europe and China. But the real story, the absolute load-bearing wall for this company's future, is that $72.2 million in direct U.S. product sales. They are no longer just a development company collecting these high-margin milestone checks. No, they are a full-blown commercial operation selling a product directly to the American market. That is a fundamental and very, very expensive shift, and it's the entire basis for the bull case. Okay, a solid first year of sales is one thing, and a product that people clearly want is the first floor of the building. I'll grant you that. But a building is only as strong as its foundation. And when I look at the rest of these financial statements, I'm not just seeing a few cracks here and there, no. I'm seeing evidence of a potential full-on structural failure. This right here, this is the number that stops you dead in your tracks. In 2024, before the full commercial launch, ARS actually turned a profit of $8 million, probably from those high-margin collaboration milestones you just mentioned. 1 year later, after a successful product launch that brought in over $84 million in revenue, they posted a staggering net loss of $171.3 million. How do you go from an $8 million profit to a $171 million loss? You don't do that by accident. That is a conscious, strategic decision to burn cash at an absolutely incredible rate. That's not a crack, that's a sinkhole opening up right under the company. And this right here brilliantly illustrates the entire issue. That sinkhole has a name: Selling, General, and Administrative Expenses, or SG&A. Just look at this chart. In one bar, you have the total revenue for the year, $84.3 million. In the other, you have just the SG&A expenses, $230.1 million. They spent nearly $3 on sales and marketing for every single dollar they brought in. Think about that. R&D spending was minimal, only about $13 million. This isn't a research problem, it's a cost of sales problem, and that is exactly where all the cash is burning. Let's break it down even further. The SG&A is so massive for a simple reason. They are building a commercial empire from absolute scratch. That $230 million represents a huge direct-to-consumer, or DTC, marketing campaign. Think TV commercials, online ads, all of it designed to get patients to walk into their doctor's office and ask for Neffy by name. The company even stated that the DTC spend alone in 2026 is expected to be around $100 million. On top of that, it's the cost of deploying a national sales force, hiring, training, and paying salaries and commissions for representatives to get into doctors' offices all across the country. And they're expanding that force from 106 to 150 people. This is the absolute definition of spending money to make money, but the scale of the spending is just immense. So the strategy, and this is straight from the CEO's mouth, is to spend your way to the top. Burn cash to grab market share. But the question every single investor has to ask is this: is this a disciplined investment in building a durable, long-lasting franchise, or are they just throwing money into a bonfire? A negative net margin of over 56%, that is more than a red light, it's a 5-alarm fire on the balance sheet. They're telling the market this isn't a one-time expense. No, this is the new cost of doing business. That's an incredibly bold and, potentially suicidal strategy. And this is the number that determines whether they survive that strategy. They ended the year with $245 million in cash equivalents, and short-term investments. Now, management claims this is enough to fund operations all the way through to cash flow breakeven. That is a very, very confident statement. So let's stress test it right now. They lost $171.3 million last year. Okay, that works out to a quarterly cash burn of about $42.8 million. At that rate, their $245 million gives them a runway of about 5.7 quarters. That's less than a year and a half. That's the ticking clock. The absolutely crucial point is whether they can control the burn and accelerate revenue fast enough before that runway runs out of tarmac. This is the central tension of this stock, and every single quarterly report from here on out is a test of survival. Okay, so that brings us to the battlefield. The company's financials are under intense pressure for a reason. You don't just build a skyscraper by putting up a few billboards. You have to win a ground war, doctor by doctor, insurance plan by insurance plan. And this is where we see the operational stress that's causing that massive spend. Okay, so ARS has actually done a great job on the surface level. They've secured 93% commercial coverage, which means the vast majority of insurance plans will cover Neffy in some form. But here's the friction. Look at this donut chart. Only 57% of those covered patients have what's called unrestricted access. That means for the other 43%, a doctor has to fill out a bunch of paperwork and get pre-approval from the insurer, a process called prior authorization. Now, for a busy doctor writing dozens of prescriptions a day, that administrative hurdle is a massive, massive deterrent. It makes it so much easier to just prescribe the old, unrestricted auto-injector they've been using for years.
Exactly. So even if a doctor or a patient actively wants Neffy, the entire system is literally built to make it hard to switch. We're talking about a mature market where about half of all epinephrine prescriptions are just simple refills, written electronically without an office visit. The doctor's software just defaults to the old drug, the patient is used to the old drug, the insurance plan makes it easier to get the old drug. So they're not just fighting a competitor, they're fighting against decades of muscle memory that's embedded in the very infrastructure of the healthcare system.
And look, management isn't just sitting back and watching this happen. This is the heavy lifting their SG&A spend is paying for. They're countering these headwinds with a very clear strategy. First, expanding the sales force. We know that. Second, that massive DTC campaign we already talked about. And third, and this is pretty clever, they've launched the Get Neffy on Us program. It's a brilliant move, really. It creates a virtual pathway where eligible patients can get a prescription via a free virtual visit and pay a $0 copay, completely bypassing the friction of an in-person appointment and all those insurance hurdles. Now, sure, it's a short-term revenue hit, but it's a strategic investment to build a user base fast, get the product into people's hands, and generate real-world data that they can then take back to those payers to demand that unrestricted access.
So we've examined the blueprint and the breakthrough product. We've stress-tested the foundation, and we found a massive cash burn. And we've walked the battlefield and seen the heavy fighting required to gain any market access. So let's bring it all together for the final verdict.
You know, when you lay it all out like this, it's a classic Wall Street battle. On one side, you have an incredibly compelling bull case. I mean, a truly differentiated, needle-free product in a huge market. A strong launch with over $72 million in first-year sales. A clear strategy to overcome all that market friction. And let's not forget, the big money is betting on them. 68% of the stock is held by institutions. But on the other side, the bear case is just as powerful. A balance sheet that's just bleeding cash to the tune of a $171 million loss, SG&A spending that is completely, wildly out of proportion with revenue, and significant structural friction in the market that costs a fortune to overcome. So which force is stronger, the innovation or the incineration of cash?
The verdict from Iron Financial is this. SPRY is a high-risk, high-reward structure. The product, Neffy, is solid steel. It's innovative, it's needed, and the early sales prove it has a place in the market. But the foundation supporting that product is under immense financial pressure from the massive commercialization spend. Management is betting everything, the entire company, on the idea that they can scale revenue faster than they burn through their remaining $245 million in cash. If they succeed, if they get unrestricted access from major payers and that Get Neffy on Us program really takes off, they could accelerate market share and finally reach profitability. But if they fail, that cash pile will disappear incredibly fast. This is not a stock for the faint of heart. This is a bet on whether management can seal the cracks in the foundation before the whole thing comes crashing down.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.